and I'm going to give you only sufficient enough information. How I use my charts, what elements on the charts I use for pullbacks, reversals, breakouts, or for any setup that I have. Based on this presentation, what's possible is to come up with more than one strategy for entrance and for exits. More than one. Basically, I'm going to share with you the elements. Like some of you says, oh, what's most important elements? And I'm like, there's no one single elements, but there's some elements that I need to put in order, what I look first, then second, then third. Now, and that's going to be a presentation about the elements, what I'm looking at the chart. Because on the chart, we can see a bunch of the things, right? Now, this is a footprint. I'm starting with a footprint that we actually, not many people understand, that we have a volume profile on each candle. You see the left of the candle, there is a footprint. This is the footprint left. The colors are not very standing out right now because I made them not to stand out, not to jump like crazy on you, although you can change the transparency, and this volume profile on the left side will actually cry out very loud, okay, if you wanted to. But I'm not that kind of the person. So you see the volume profile right here. You can see it right there. You can see it right over here. You can see it like over here. So the volume profile actually on very each candle. If you want to do it, you just like change the time frame and you can have a larger volume profile on each candle with a larger time frame. Now, what is important on this particular slide is simple things. Volume profile left of the candle bar and the POC, which most of you are really familiar. Now, my point is not only say, oh, this is POC. You get bored. I know what's the POC. What is the point, my friend? The point, you asking me, the point is first, footprint is the level 1 data. That's what price action people can see, and that's only what they can see. They see the top, they see the bottom, they see the candle wick and the candle body, but they don't see X-ray what's inside. What's inside of this footprint tells much more significant, more information. POC is important when we have it like on the pigtail pattern right over here. We're seeing the POC is moved over here. Where's the next POC? It's somewhere like over there. Where the next POC is somewhere like over there. So by traveling, POC traveling, we can see where the fight happens. The POC, if the candles go below, price goes below this POC and not able to and do retest like that, I know, okay, I'm changing my direction. So I'm using this on my 30 seconds time frame or 1 minute time frame also as the way to gauge for the momentum. What's the direction? Should I go long? Should I go short? Do I use that? Of course. I do use the pigtails on the 10 range, but it's going to be another story. But the point is the POC is super important on any time frame that we can estimate if the POC is traveling one direction or another direction. If the POC, that's where the volume is being traded, get reaction this way or get reaction that way. Okay, so that's how I use practically the POC. So the volume profile and the POC as a maximum horizontal volume. Okay, it's kind of related, volume profile related to the POC.
A naked POC is a POC that hasn't been crossed. In other words, it's so you have a POC. Imagine drawing a horizontal line out from the POC, and it hasn't been tested yet. So a naked POC is a POC that hasn't been tested.
So right now, this is a naked POC that's not being tested from above.
And I've run back testing through a group where a lot of us did, and that in a session, 95% of the naked POCs get tested. So they're an attraction point. So
what's interesting about the POC, it is the largest in that candle, the volume where the fight happens between the buyers and sellers. That's why this POC is always interesting. But
it acts as a magnet. It attracts for testing again. That's what I'm saying.
Yes, of course. It must be. It must be. But at the same time, I'm going to show you something that is much more predictable than POC. I'm going to show you another point that POC can become as imbalance, and it's going to be called single imbalance. It's going to be largest, probably, amount of volume traded over here. It's usually become the POC. It is the single imbalance, and you can filter it specifically over a certain amount. So this POC, you can filter on the NQ, for example. Usually I do 50 or I do 70. And this is becoming really good zone to support one or another way. That's usually. And this is like reinforcing what you just says on the naked POC into the single imbalance zone. But it's going to be on the next couple slides below. Is that okay?
Yes, yes. So you would make a single imbalance zone with a very high volume, so
Yeah.
it becomes a point of great attraction.
Exactly. Okay, let's move more. What do we also have? We have a delta block. Instead of writing a delta above or below, we don't wait until the candle is completed. This is calculated dynamically while this candle going up and down, up and down. You don't have to wait. You already see, okay, there's a delta. This size of this candle or this place in the candle is already 57. Wow. This is delta though. It's not only buyers, it is the difference between the buyers and sellers. So we have the delta while the candle is being developed. And we show it with the, you see the left one, this one, instead of this bar. This is the candle bar, and this is the delta. You can make it wider if you wanted to, as a delta block, whatever. You can change the transparency anyway. You can make it the way that it is going to be stand out for you on your charts. That's the point. But that is the something we put because we don't want to wait until the candle is completed and we're going to put number over here, because sometimes it's going to be too long. If you are scalping, you need to make a decision based on what you're seeing right now. Boom, you are scalping. 57 for this time frame, for this session is enough. So this is the way that delta can be used. And also, we do have a delta style footprint chart, or just like the whole chart, delta style. Delta blocks is also the blocks that you see there's a buyer sitting in this block, right? And you can expect if the price is gonna come and react on this block. So this whole block can be what? The zone. So we do have the templates for this? Yes, we do. Not many people ask me, so that's why I don't share it, because I don't want to overcomplicate. But mostly I use the delta blocks right here instead of just like making the delta zone over here, because people get confused. So I use that on my charts, and it's very simple, but that's what I have in order to, like, what I see, I notice the price reaction, it can be over here. And you see inside of this delta, we have delta zone. We have what is this? Is this whole delta zone is okay? So that's like
Is there an option for the delta block to expand out so you see the zone?
The delta block expanded to the right as a zone. Yes, we do have it. Yes. Okay, now, so, and there's a delta divergence. This is about the delta divergence. If the candle is different color than the delta 1 below, okay, the delta 1 can be red and the candle is green, then you're gonna see there's like a little bit right below this candle bar, you're gonna see this little circle, okay?
Oh, so that means divergence.
This is divergence between the delta 1, and it can be red, okay? Imagine this is red, and this is green bar. That's the difference between delta 1 color and the bar, okay?
I see that dot all the time. I was wondering what that was.
Settings is on the footer, not on the footprint. Now, over here, what's most important is aggressive side sellers bid and sale column. This is the sale column, right of the candle bar, and right of the candle bar on the right, we have a buyer's ask, okay? So this is ask, this is bid. On the left side of the bar, there's a volume profile, and there's a other, like a delta block right on the left of the side. That's why we have a 3 column. Actually, it's a 4, but to tell you the simple version, we have a 3 column of the footprint. Why? Because before we were using like 2 or 3 different footprints from other manufacturers. We decided like, oh, that's too much. We're gonna build our own. That's how we started our company, by the way. We combine it on the left side, we combine it the volume profile, then bid and ask on the right, and there's the 2 columns over here. And you can change, by the way, each of these you can change as a delta, like this bar, what you're seeing over here, or as the bid and ask. Right now, I think that it is configured for the bid and ask because you see this is a green, this is red, this is green. So this is the delta, what you're seeing on the right side in terms of like inside of those tangles right here. But you can change it to the bid and ask. Right now, this is the delta. People like, oh, you have that. This is delta. Yes, sir, it's delta. The bid and ask is actually tells a lot of story. A lot of story. And one of the story is what? One of the story
Who's winning the war?
That when we're seeing this, you see this 6, 5, 3, 6, 5, we do diagonal on a diagonal 1 to 5, 1 to 6, 1 to 3, 1 to 5, 1 to 6. There is a more than 200 to 300 difference in ratio that define the imbalance between bid and ask, between the buying and selling, not bid and ask, but buying and selling, because they calculate on a diagonal. And that's why this zone is now imbalance zone by the buyers. And I color it as slightly blue instead of the green right over here, right? So instead of like a green like over here, I color it stand out and larger in font. So boom, I can see instantly if this bar actually was able to close here and immediately goes down, I know this is gonna be stacked buyers in a trap. And it's quite often that it happens that way. Anyway, this is the footprint. And on this footprint, we're not just to make it like me to sit and calculate 1631. No, we highlight it visually. So our footprint is visual. No need to calculate like the other footprints. They just like the numbers here and numbers here. I'm like, I don't have a patience for this. I don't have a nerve for this. I don't have a brain for this. I don't have intelligence for this. I don't have a time for this. Then we optimize it for what? For the fast decision making in the snap. That is why we build our footprint, not just for the, sense of the prettiness, but for the sense of the saving the time for a decision. So now the same for the, like over here, you're seeing the 555. Okay, you see the enlarger font and other, like I made them yellow instead of red, like over here. So this is like visual cue to make a decision in a very short period of time, even not without thinking about the numbers, without any calculations. I think that Mr. Einstein will be, if he is alive, he's gonna say like, guys, I love that. I don't need to think about it. So buyer zone, but how do I use the imbalances? You see that I put like FVG. This is a little bit controversial topic. FVG, fair value gap, means absence of fair trades between left and right. You see 1, 2, 0, 0, 1, 0, 1, 0, 0, 0, 0. That is the gap in trades. Nothing is being almost trade over here. The price made what? Some people call it, this is single prints, but look, most people get confused. Should I trade the fair value gap and expect the price gonna come back over here? But now, indeed, there is a buyer sitting here in the blue. You see, this is the buyer's zone. And when price is coming here, price get reaction, price get reaction. What does that mean, actually, price get reaction? Why? Because this buyer is showing them that I'm still sitting here and I'm gonna support this zone. I'm a buyer here and I'm gonna continue to prove that I'm a buyer. So that means that imbalance zone, even the terminology is close to what people on a price action use. It's not the same freaking imbalance zone. It is imbalanced by the buyers. So this is a breakout imbalance in my book. Actually, I'm not the one who named it this way, but I more now understand how to trade the zones like this, zones like this, zones like that. You see the zone, boom, get reaction. You see this zone, get reaction.
So you set limit orders on those imbalance zones, and when they hit, you immediately grab up a handful of ticks.
Yeah, exactly. Now, the point is, I'm not confusing imbalance zone with other imbalance zone. What people say in the price action and what you see on the volume action, it's not the same things. Now, when the price is tested this imbalance zone, and these guys prove it, I'm still here, but then the price went a little bit lower. You see, they're now testing this guy. Are you here or not? Later on, this price actually went lower up to like, I think I don't remember, but it is logically expect the more attempts is being done, the more chances the price gonna go and test this zone. Price may actually come and test this zone as well, because this zone where the price decide, no, this zone is totally like uncomfortable for me to buy or to sell. I don't want to sell lower than that. So people on a level 2 don't want to sell lower. They will just like, no, I'm not going to sell lower. That's why the FVG may play the role. But we need to make a distinguishment or difference between the FVG and the actually breakout zone. Next time, if the price is going to come again and I see there's a lot of delta over here, there's a chance that I'm going to put my stop loss below. Yes, exactly. Price tested over here. So I move my stop zone, my stops over here. Because stops needs to be moved dynamically instead of like 5 ticks only. Dude, if I'm absolutely thrilled and confident that the price direction, momentum, and trend is going up, I'm gonna risk more. I'm gonna say fuck to everybody else who is telling me if you're moving you stop lower, you are making me. Yeah, I'm not gonna move it 100 handles. I'm not gonna do 100 points. No, but I have my own limits and I use my stops dynamically. If I'm confident the price is going to go up, it's already in the trend going up, I'm going to put my stops right over here. So where are my stops right now? Right over here. This is coming from my live trading. So it's not just like hypothetically. That's exactly what happens. Do you have any questions about that or comments?
You got to set it by volatility and how choppy it is. If not, you'll just get chopped out every time.
Absolutely, sir.
Always different. It's dynamic, like you said. You can't just. I mean, it could be, between 9:45 and 10. You might need 40 ticks stop on NQ or more, and on a Monday it could be choppy as shit, and you got to move it back a bit. While on a day where it's less choppy, where they're distributing, then you can move it up. It's not going to keep stopping you out.
That's
So
other good points. Yeah, I do appreciate what you're saying. Volatility.
all practice and experience.
Yeah, experience and we need to give the space for price to travel instead of always hitting. Now imagine, because this is the imbalance zones, right? Imagine that this is like 70 over here, and that's become the single imbalance. It's going to be only one tick, single imbalance. It's going to be green. And usually this single imbalance is on the space where this is the zone that is taking, like, you can mention more than three or more. This is a stacking one, stacking second, stacking another one. But let's say this is like only one, and this single, and usually it creates a POC, is I do 70 on the NQ, 70 or 50, depending on the session time, and it's really working well. So we do have settings for anybody set this single imbalance, and the POC plus single imbalance in the same spot works like magic.
I got a question about that. So you're basing it on volume. With the higher volume, it's more apt to have reaction. But what about increasing the percentage of difference? Like the single balance would only have to be like 500%, 400 or 500% instead of that 210%. So you have a much greater difference between the buyer and seller.
Yeah, I do that on the NQ on a high volatility. The minimum we have 210 in the settings. Now I actually notice that most other people use 300%. If I have a high volatility, absolutely, it's time to increase it to whatever 400 or 500, but it depends on what you want to see. Too many or on a time frame you trade, so you definitely can increase from 210 to 300 to even 500 if you wanted to, but see the chart that you're trading and the ticker that you're trading and the volatility that you're trading, if that's gonna fit your picture at that moment of trading, okay, and the moment of the chart and the time frame and all of that. So
I would think you get a bigger reaction with a higher number.
Of course, definitely, the higher the number, it's probably going to be higher reaction. Now, I'm going to change my subject a little bit. Most of you know really well what you're seeing on this chart. The key is, if I'm asking a price action person, what moves the price? Level 1 or level 2? They're just like, what's the level 2? You don't know what's level 2? Aha. Because most people on a price action, they believe that buyers and sellers, that's only two entities out there. My point is the invisible level 2 for the price action people, that's what moves the price up and down. Price is moved by aggressive side of the market, level 1. They impacting the price. But if the orders on level 2 are stronger, they can absorb any sellers and buyers on the aggressive side by the market. So the price is moved on level 2. Here is the statement that probably you've never seen on any presentations. The price eventually moved on the level 2 passive limit side of order flow. Okay, I never seen that statement anywhere. Now, so the price is defined by the ask and a bid on a level 2. And a bid and ask on a level 2 that's what define the names of the bid and ask. Here it is how. Most people, when they explain the price auction or action, they talk about buyers and sellers. And I want to say, guys, you are totally killing me. 2 or 4 participants on the market. Because most people on the price action are going to tell you there is only buyers and sellers. You see what I mean? There is a 4 participants.
Those are buyers and sellers on passive and limits.
There is a 4 participants. Price action people only think 2, and they completely dismantle, blind to other participants. So that's why they have a lot of confusion, because they're seeing half of the market and they don't even think in a paradigm of the 4 players of the market. There is a 4 players on the market, not 2 players. And this is paradigm shift, the significant paradigm shift. When I start using the volume indicators, I'm like, wow. The aggressive side buyers buy from the sellers on the passive limit side. This is aggressive, and they called ask. These on the footprint, they called ask, isn't it? They hit, and the keyword is hit. The ask on the limit sales, limit order sales. These guys are selling, these guys are buying, and they matching. These guys never meet another aggressive seller. Never. They never meet the seller over here. No. They meet with the other side of the order flow. That's why we have aggressive side and we have passive side of the order flow. So the ICT, when he talks about buying side and selling side order flow. That's completely misleading, because there is a order flow is on the aggressive buy market who want to sell or who want to buy immediately. That's why they called aggressive buy market. Market mean immediately, not the whole market. The passive side is simply sitting and waiting until the price is gonna come and trigger this order. So that's the matching, the ask. This green guy is called ask because they matching this ask. This is the sellers. But the name on a footprint travels whom they hit. And the logic is for the names that these orders hitting the ask. So if you seeing the ask over here, that means this guy's buying by hitting the ask on the limit side of it. And this is the logic why this is ask and this is ask, because this guy is hitting the ask. And then on the opposite side, this is a side for the beads, the red ones. On the footprint, this is a footprint name, they hitting the bead on the limit or passive side of the level 2. That's why they call the bead in red on the footprint, because they matching or hitting the bead on the passive side, because the passive side that's what define the price to move, not the aggressive try to, but they not always succeed and overpower the passive side. So that's where the name is coming from. This is the summary. Aggressive bid, hit the bid on the passive side. Aggressive ask, hit the ask on the passive side. And this is the 4 players. 1, 2, 3, 4. 1 and 3 never meet each other, but the people on a price action, that's all they know. The main point of here, there's a 4 participants, not the 2. And that is the main huge difference between any price action paradigm, thinking, mentality, because they always talking about the liquidity on top of this candle or below this candle. Dude, liquidity is sitting only on a level 2, not on level 1. Let me, before we're gonna go on the DOM, I'm gonna explain market delta bubbles. This market delta bubbles, when you see the market delta bubble, it is the same if you kind of like, I can see through it, like right over here. Maybe you can see that there's a 21. You see this 21? And I think that there is a 0 on the buying side. This 21 is 21. So the bubble is negative 21 or sells 21 because there's a delta sitting right there. So what these bubbles are doing, they are kind of like a better presentation of this side of the delta on a footprint. It's simply a bet. This is a 24 in sales, and there is a what? 1 or 2 in buys. Let's say probably whatever, maybe 3. So that's why the delta is 21 over here. So the bubble is a better presentation what happens over here in delta. That's what it is. It's a difference between the buyers or sellers or bid and ask. So that's what the delta bubbles are. Now, how do I use that? The usage of this coming from where it is, where the bubble is sitting. If it's sitting at the very, like over here, do you guys see that it is on the wick of this candle? On the wick over here. Could you see it? Now, of course, by looking at the pigtail pattern, yeah, boom, we bounce it. Now,
it's a super pig when it has a pigtail with a bubble.
Yeah. So the delta bubble is the better visualization of the footprint, basically, on the bid and ask side. And when you see it at the below the candle body, because candle body is right here, or candle body is right here, when you're seeing it below, that means that is a absorption. You see the reaction? You see the reaction? Absorption. You can define it that way if you wanted to. That's my definition. That's how I look. But if the bubbles, let's say at the beginning, that means that's an effort. That is the effort. That is the effort. So I consider if the red bubble over here creating a momentum to go down. Over here, you see, there's this is like a substantial delta, right? There's a substantial delta. And now you see that after this substantial delta at the very end of these weeks, we're seeing the what? Boom, reversal. So this is for me a indication or what's preceding the reversal. I'm looking for this. I'm like, oh, I was waiting for you guys. I was waiting for you because you at the very end of this candle, fantastic. So I'm ready to what? For reversal. You see a green rectangles behind these bubbles. I made semi-transparent. There is a rectangle here, rectangle over here, rectangle. There's a bunch of them over here, okay? And you see these two rectangles, and you're seeing these two rectangles, and you're seeing these three rectangles right behind the bubble.
That's absorption.
You can hide the bubbles behind the footprint, and you will see them on top. But what are these footprint rectangles mean? It is in the settings for the footprint as absorption, okay? What is the absorption? And this is the absorption, and this is the absorption. And the bubbles simply confirm for me at the end of the tick that they're being absorbed. Why? Because absorption, when the price is traveling from the spot of absorption a certain distance, when the price is traveling, not just being hit here, but price is traveling to, you see this beginning of the candle? So the price is traveling certain distance. That is why settings for absorption, true absorption, on the footprint, you see like over here, on the footprint. Now, when you want to know where to tune the absorptions, because you can tune the distance or amount of volume you want to see here for a different session, you know where to go. Footprint. This is two kind of like indirect bubbles indirect, and these settings on the footprint direct way to read absorptions. And definitely when there is series of absorption than what I expecting. This is like, okay, get ready. Sometimes one absorption is good enough. If there's like a 500 over here in absorptions, that price should be reversing. Why I put this slide again? Because it was a real trading, and my point is that quite often I don't wait for one single absorption bubble like that. I'm waiting for series, maybe 2, 3, 4. So I'm not jumping my gun. I'm not jumping my gun because my stop losses will be large. I'm going to struggle with my emotions for a drawdown. I don't want to do that.
You wait for a range to start forming. So it's a gentle curve, the reversal, not just a V type.
Oh, the gentle curve, it's my favorite. I mean, you like right in the spot. Absolutely. Because sometimes reversal can be fast like that, and it's really like, that's not what I trade. When it's like happens like that, or like happens like that, it's like it's really hard to catch it, although you can. But the gentle reversal like this, pullbacks, those are my favorites because I can get my best setup in a gentle, rounded reversal. So this is the practical way.
You know what they say, a fast move is a fake move and always comes back, while a slow, gentle move is building consolidation for a major move.
Yeah, it is. I agree with you. That is how I use these bubbles. Before we're going to go to the MBO, the things that you mentioned before, this is the delta level 2. Technically, it's not delta 2. But it is we call it delta 2 because it's a delta between pulling and stacking that you see on the DOM. In one of our indicators, this DOM is showing on a past DOM, it shows the pulling and stacking. What's important for people to know that I can set this indicator, this pulling and stacking can be tuned to 5, 10, and general is 14 price levels over here. Above and below the price. Let's say the price is over here. So you want to get more precision, you lower it to 5 or 10 or 7. You want to get bigger picture, like on S&P, you tune it for a larger number. That needs to be tuned to your time frame and to a level of precision you want it to. And the way to tune these indicators is actually on the indicator. Now we call it past DOM. In the future, it will be a separate indicator, but on a past DOM, there is a pulling and stacking section. That's where you tune how many levels you want to show over here, or like get calculated from how many levels, 5, 10 or more. To be precisely situational indicator, not the average pulling and stacking. It's on that very concrete time frame. Are there any synchronizations that we can see over here? You see there's a red delta 2, red delta 2, green delta 2. Delta 2, when it's combined with the red delta 1, aggressive, combine it over here with the small differences. But basically, in general, it moves the price down. When it combine it with the delta 1 bid and ask over here, it is moving the price in the same. So synchronization on the both sides of the market, that is the point. If you want to be granular, you can use the market speed, because this is the last. Who was the last in this candle? Like in this one, a lot of delta 2. And the last on the bid and ask was who? Sellers, red. And there is like outline yellow around it, because the sellers were the last one in this very candle on the bid and ask who increased momentum. It is the speed or acceleration. Over here, you can see that that was a green accelerated, last one, green accelerated. No, this one is actually red accelerated last one, but the green were larger than the buyer, the sellers. Here, I say the green were the last one, and they accelerated in a larger speed than the sellers over here. So when it's combined, all of them three together, this is a co-influence. Can you use that as a co-influence? I don't know, but I'm very excited to see that these three indicators, when they align it like a stars on the sky, I'm like, dude, this is the good ducks in the same row. That is the co-influence factor between the delta 1, delta 2, delta 1, delta 2, and the market speed. Although there's one more correlation on that slide. There's another correlation, not just that this is the same slide, by the way. Look at the another correlated factor, size of this candle bar. You see that? Small, teeny beeny. Doji, this one, the bar is small, the wick is large. Now look at this volume, large volume, large volume, large volume, lower volume. The transparent bars behind the delta 1, it's a volume. So we simply put together two indicators in one, delta, which is green and red, and the volume, semi-transparent gray. So the volume is decreased volume. Look at this volume, candle bar is small. Volume is lower than the previous, significantly lower. Look at this volume, teeny beeny volume. And now, one time, low volume, second time, low volume, third time, low volume. Low volume and the short bar. Low volume and a short bar. Low volume and a short bar. What do you see after short bar? Extension. What do you see after this short bar? Extension. And number 1, 2, and 3 tells me that if I'm executing my entrance right here, I'm jumping the gun. If I want to be a perfect, the type A settings, I'm going to wait one time, second time, and usually third or a fourth time is the best, safest for my trade execution. This is another co-influence factor along with the other factors. You see the high volume level 2, it happens, high volume 2, and the next candle after low volume, it is amazing. It is a high level 2, but then we kind of continue, level 2 is still active there and still present. So this is what cofactors I'm looking for, and I like that I have these additional cofactors. The low body, size of the body, this is where usually I consider the tension. I can actually continue something like this, and usually after that spring, the price is springing, like the more it's like, the longer it's going on a tangent here, on a sidewalk, and the smaller the candles, smaller teeny bitty, the trade is going to be big. Now, of course, you can wait until there is a Vikov happens. Does it actually happens over here? I can say yeah, because this is what actually the fourth phase of the Vikov, or this one, that's basically what's going on. Quite often in a reversal like that, I always look for a Vikov. Doesn't matter the time frame, one teeny beeny time frame or the large time frame, I always look for the Vikov. Especially, I know the Vikov, how it behaves on gold. I notice the patterns of the reversal on Vikov reversals on the different tickers. Yeah, here we go. This is the DOM. So this is the DOM, and the DOM is very simple. The DOM is because it's a market by order, we can see, I'm not going to give a whole nine shebang about that. Anybody can watch it on our website and click on the page MBO, and you will see the definition and user guide give a complete definition, all of these things. But we're seeing that this person put 5 in order, 10 in order, 10, this is the volume, right? This is the volume and volume. And there's some small people over there with a volume like 1 or 2 or a 1. I filter it up to the what? I filter up to the 4 or 5. 1, 2, 3. You don't see the numbers over here because there's too many of them and there's going to be too many numbers. So I clean them out. I filter them out. But together, volume is 35 on all of this. This one, large one, this one, and this. All of these 35 in volume. And how many people or how many contracts? 12. How do I use that? On a very slow market like gold in Asian session, I really love to see larger amount of participants, that mean contracts, to compare with the volume. Because volume, if this 10 is moved out, I lose this volume very fast to 25. Or if both of them fade away, change their position above or below, I'm gonna see this immediately. 20 minus is gonna be only 15. So on the gold, in that situation, you can set it as the comparison between the volume and the contracts. There's a settings, you can put it less, I think it's less, yeah, I think it's less. On the S&P, I change it to more. What is more, contracts or the volume? So you're able to filter it, and it's like immediate filter for me, because it's kind of like a show me in a very like a fast way that I need to keep attention on this, okay? Because I set it up. You can set it up depending on the way you want it to. So, and this is really good way to tune it. There's no any other DOM on the planet Earth that is capable to give you that filter. We actually have it, and it's a little things, but I like that because I use this. Now you can see that these fives, and you see these fives, and you see these fives, fives, on an early gold, on a micro gold, I noticed that these guys, these fives, can be taken away in a split of second all at once on the gold. And this is particular to the gold because I'm explaining you how I trade. And I see if these guys can be taken away in immediately at the same time, for me, it is indication, and maybe this is my bias, it is bots, algos, market maker, whoever it is, but it's not the people, not real trades out there. They want to impact, they want to show over here, they balancing micro gold with mini gold price. So there's no arbitrage between them. That's why these guys are sitting over here. Whatever the job they're doing their own job on the CME exchange, whatever they're doing, but I don't count them. Sometimes you can see instead of 5 layers, there's like 6, and all of them 6. Like, what's the heck? So I don't even count them. That's why on the gold, on a micro gold, I see the amount of people is more important for me, or contracts, than the volume. This is my personal settings. I'm not telling you that you need to have these settings. This is definition of the MBO. You can read it. Anybody can read the definition, what it does. But anyway, the MBO is really awesome for me. Definitely, I can use it for the stop losses, and I can use for the take profits, right? Because if I put my entrance over here, where do I put my exit? To be confident? If this is like, you see how stronger it is to compare with this? Whoa, 14 and 35 on a very early Asian session, 20 in difference. I want to exit over here, 1 or 2 ticks below. This is my exit, take profit. Or if I'm trading opposite direction, it can be my stop loss. Stop loss, I'm going to put my stop loss above that, and I'm going to hide behind this volume, right? So that's how I use And the MBO is really awesome because it shows in a real time the situation over there. I can move my stop loss or take profit if I see that they open and they remove all of these orders. I'm like, oh, there's nobody over there, so I can move my take profit higher, so I can make higher profit because it creates the vacuum right over here if they move all of this higher. I use it for the stop loss. I use it for the take profits, support and resistance zones. Yes, I do. On my Sniper MBO, and anybody can download my PDF for Sniper MBO from our site free. I put sometimes I put my order along with these guys or like a 1 or 2 ticks below, and I expect if the price is sitting somewhere like here and it's not moving like that, because this is the way to eat out that liquidity. But if the price is shooting, it most likely is going to bounce, and I'm grabbing 8 to 10 ticks in profit, 8 to 10 ticks easily. And I have the whole strategy based on that. And thank you for mentioning this. This is really smart that you actually.
And on Q, I got that set for 15 and 20 or 25, and I always get at least a 15, and then I have a button that the minute it hits a 15, I hit break even, and about half the time it makes it to the TP2. That's how I do it, and I don't lose much of anything because I just constantly break even. Half my orders are break
Yeah, exactly.
even.
With the experience, we can see that sometimes it can be break out for a certain amount of ticks and then come back. If the price is shooting from the distance, you see, from the distance, not from the short time. If prices accumulate here for a while, like a first attempt, second attempt, third attempt, I'm not gonna do bouncing. I'm not gonna.
Yeah, I cancel. Yeah,
Yeah.
If it doesn't shoot and take it right away, I cancel the order immediately. And
there's a whole strategy that can be developed, and based on experience, you can calculate where do you need to put your order, sometimes even beyond this level. Depends how strong is this level is, okay, sitting on what volume, how many contracts, all of that. So there's a whole strategy can be singly developed. Another way to use the MBO, we can see that sometimes the pressure can be from above or from below, and this is the DOM pressure, that the DOM, let's say if there's more of these guys, this 100 is, I know that it's market maker, but let's say if this is a real person, that definitely summary over here is larger than over here. And the price, anyway, the price is attracted to liquidity, so it's most likely they're going to travel up. By looking at this, sometimes that's what we saw on the ES a few minutes ago, that there was sitting a lot of orders right over here, and dude, I don't want to put my take profit above that. It creates a live up to the millisecond resistance or support zones that is more, in some sense, sometimes more valuable than the heat map, because heat map, it is the same prices sitting there for a while in time, and as a history that, over here, you're seeing my heat map, which is colored red and green. Below is green, above is red, and you see these guys were sitting there for a while. These guys were sitting there for a long while. So this is the heat map of these guys sitting there, history of them. If they're sitting there for a long time, I consider this level is strong. If this guy is sitting there just shorter time, I don't consider this on the MBO as strong as this if these guys spend more time on the left. So the combination of the heat map with the MBO DOM give another interesting data that we can use as a cofactors between these two indicators, heat map and the MBO.
Yeah, I use them both together.
Yeah.
So the stronger the MBO and the stronger the liquidity line, the more I'm apt to.
The heat map can be used by the blue and red, the color scheme. It doesn't matter which one you use. I use both of them sometimes. Actually, on this very screen, I use both heat maps. Surprise, surprise, but sometimes I do that because this heat map, for me, even this chart is micro, I put this heat map from the mini. Combination of the heat map and the MBO gives definitely a boost in the looking at as a cofactors. Now the icebergs is, people ask me why there's a square, why there's a round. Round one, this is a cell one, is aggressive. And if somebody needs to see what's the aggressive iceberg, because it's a level 2, yes, it's level 2, but they active more aggressively, and I explain in the details on this very page. There is a definition of that, and usually price love to follow more with the aggressive icebergs to compare with the normal square. We give you two shapes to mark one or another. This is the beginning of this iceberg where it's been conceived in time. It was being conceived over here, and quite often you're going to see that it's going to be conceived on a very different price level, and it's traveling, and boom, it's realized right over here on this dome. This is the container on the dome. Yes, we are the only people who show you container for the icebergs on the dome. There's no any other indicators on the planet, I'll have to repeat it, that show you a container for the icebergs is going to be refilled again by these guys. So it's been 39 refilled one time, 39 refilled again, a second time, you see one, exactly the same, and now there's a 23 ready to refill. This is a pretty substantial, because usually you're going to see one or two, and this one and two in volume over here will be refilled with this size 36. I don't know why they just like, they really standing out with 23, but usually it's like one or two or a five, but no more than that. Now they have a large container. This is the container for refilling, and you can see in real time, especially on the slow market or on the time of rebalancing, when on the ES rebalancing at the 4 p.m., you're gonna see how it's refilled in like amazing in real time. I consider that there is two different strategies to trade them. Even simple strategy, if it's below the low or above the high, that is an easy strategy to understand, to align with the extremums on the high and lows. And there is a more sophisticated way to trade it, looking at the reaction, price reaction, not at the color of the iceberg. So I have another videos about that, but basically sometimes I do use the icebergs if you know how to use them, especially at the very beginning of the session on the gold. And this is my favorite. Everybody already know what it is here. This is the pigtail, and this is, I just made it large because the pigtail is where the POC on the footprint. This is a footprint pattern right over here, and the POC at the bottom. And by the way, this is the extremum, this one. This is, I enlarged that piece over here. Bottom line is, when you're seeing extremums like this, extremums like over here, then it's really where you have less false positives. And the bottom line is the POC at the bottom of the green candle, we're moving up. When you see two or three of them like that, this is not best one. If this POC is at the lower part, then I prefer it, because it's basically like gun shooting up there. And that's how it works. And on a sell side, it's going the same way. POC on the red candle at the upper side of this weak, second one, and the third one. This is just like 1, 2, 3 confirmation. If you're conservative like me, this is the way to grab whatever rest of the ticks for absolutely confident trade. And that's what I like. When there's like a 2 or 3 of them, dude, this is absolutely great cofactor. So I align pigtails patterns like this. I align it with the other factors that I previously described on another slides. So now, which one of my favorites? The direction I consider more or so by the structure. Let's say this is a structure. Okay, I consider, but not on this time frame. I take a look the, let's say, 5 or 15 minutes or maybe 30 minutes time frame, right? And I take a look at that by squeezing this chart with the pigtails and enlarging this whole things. I can see, okay, the main direction, where are we going? Immediate trigger for me is actually pigtail over here. And sometimes, by the way, pigtail pattern tells me, oh, you are too early. Where you are too early? Right over here, you are too early. So the pigtail pattern tells me too early, and I see the same zone, a POC, though this is the zone. Obviously, on a volume profile, you're gonna see bell curve like that. So, if we kind of coming over here and we bouncing, definitely, but The Pigtail patterns tells me you are too early, or you are too late, or you right on time. So there's a three kind of signals I'm gaining from the pigtails, and it's always on my charts. Like on 10 range, the ranges equalize kind of the movement up and down, and it give you a summary. Okay, after struggling up and down, like on a time frame candles, you see the final result of that in the 10 range, or sometimes it's 15 if it's a NQ high volatility, definitely 15. That's how I use the pigtail. It tells me yes, too late, not enter, be careful, or yeah, that's a perfect. That's kind of the cofactors I have along with my other indicators. There's a lot of things I can see. I can see the bubbles, align it with the footprint, and I can see a lot of things. If I want to expand it, you can see the footprint is integrated with the heat map, integrated with the icebergs, integrated with the all other indicators on the same chart. This is never done before. This is on the same chart, and it's possible for anybody who is trading bookmap, heat map, come and change their heat map to the one that you can filter so well, like so clear, like on this very slide. You can have all of the indicators, and you don't need to, like some of the people when they trade, they're just like, I'm looking at their videos and they're like looking at the left, looking at the right. They have like 8 different monitors and they're looking left. I don't know about their neck. I don't know how their neck is working. I'm looking at the same chart. If I wanted to, I can leave only 3 indicators and spread it the same chart on a second monitor if I wanted to. We build only heat map that doesn't freeze on the New York Open. Our indicators, if you clean it with a Ninja optimizer that we have, you clean the data, you run the fresh charts, you run it according to my instructions, you're gonna run real-time, no delay data on the footprint, on the bubbles, on the heat map, and it's not gonna freeze on you, because so many people last 2 weeks lost a lot of money, and they actually reported they lost a lot of money because of the freezing on the heat map. And the bookmap heat map is freezing, and when they're freezing, it's very unpleasant. They simply skip to show that data that is being frozen. That's how they do. We compare that a few times, and this is very, very unwanted for anyone who trading their own real money. Right now, we are faster than any heat map. We faster than the bookmap heat map, and this is really a breakthrough. What? We're gonna give you capacity to trade on a high frequency if you wanted to, with absolutely millisecond accuracy. This is different elements, what I use as a cofactors. The next presentation will be about how I put all of them together on the same chart for the pullbacks or the breakouts, and you will see my exact examples, how I trade pullbacks, reversals, and the breakouts on the chart, practical implementation, all of those cofactors, and how I trade it. You're already seeing a bunch of my videos. You can watch them. That's all I trade: the pullbacks, reversals, and the breakouts.